Tax mitigation strategies. Hey, we're all about saving taxes, are we not? Especially if you do it legally, ethically. Maybe find the gray area in the law. Nothing wrong with that. You have good CPAs that advise you. I'm a fan. Just always know what you're getting into. The areas that I find a lot of trouble with, problematic, are some of the tax strategies, maybe I'll even call them schemes, that are written by people who certainly, I hate to use the word prey on, but prey on is probably the word. People who always want to save on taxes. And that's who? That's everybody. That's me. So show me a way I can save on taxes when I sell my business, my practice, my dental practice. So show me how I can save on taxes when I sell my commercial building, real estate. And with real estate, there's a 1031 exchange that is available. It's been around for decades and decades. Uses the Starker rules, and it's very conventional. There's nothing schematic about it at all. It's well written. The problem with a 1031 exchange from one property to another is the rules around it. Very limiting, very difficult to do in an environment like we have today. So it's hard to make that happen. The other side of it is one can use what are called DSTs. There are deferred sales trusts, and there are Delaware statutory trusts. Similar concept. One is for real estate. One really can involve anything, other assets. So it's the DST, the deferred sales trust, that you can conventionally create an installment sale out of the sale of your practice and pay taxes over time. That's the proposal, the premise. The Delaware statutory trust is one that allows you to sell real estate and 1031 into other properties that are held for you on a passive basis. Both of the premises here involve deferring tax. Keyword deferring. Not reducing, not eliminating, just deferring tax. What's the problem there? For most people that have assets of any kind, your taxes are not going to go down. The government today needs more and more money, and taxes will likely only go up. So by pushing off the taxes to a later time, when these assets may actually grow over time, you may be paying more in tax. Now, the other side is, well, I can compound the gains and make up for that. Maybe yes, maybe no. How well can you make your money work for you, your equity work for you, outside of where you've held it for many years, in the practice or in your commercial real estate building? See, that's where you've had hands-on. You've been the owner, occupant, the tenant, the payor. In these cases, you have the control. When you move into a 1031 situation through DSTs, Delaware or deferred sales trusts, you lose all control of those assets. Yeah, you lose control. In fact, the rules are you can't have control. Somebody else, some other sponsor, is going to be managing your assets for you. You lose control. These assets are typically tied up for years, so there's no liquidity. You lose control. You can't make claims on them. You can't change management. They control it all. And of course, they, the sponsors of these plans, do it because that's how they make money. And there's nothing wrong with making money, but they're making money off of your assets, and the fees are quite substantial. You think you might be able to get an 8 or 10% return on your money, which you should be able to do today, but the dilution factor and the fact that real estate right now commercial is on the downtrend, interest rates going higher, doesn't make this really a very promising mode going forward in many respects. So I just caution people to not run for these schemes too quickly. You need to really sit back and get some insight into what you're really getting into. The complexity of these plans, these schemes, these strategies are very, very deep. And once you're in them, entangled in them, it's very difficult. You really can't get out. And your money's tied up. You don't have control over it. You just get what you get. And many people, I think, on the back end are going to feel like they really took a wrong step, a wrong path, when they could have just kept control of their money, held it, learned how to make it work better for them, and been much better off in the long run. Caveat emptor.